first.
Do you want to
sit right there? Oh, well, problem is that
I'll take that seat later.
19th century nobility.
Buenos días a todos. Lo primero de todo, agradeceros que nos acompañéis hoy aquí, en este Investment Day que hemos preparado con tanto cariño, después de estos 3 años de parón forzoso que hemos tenido desde que celebramos la última edición. Yo creo que el momento actual es un momento cargado de incertidumbre y por eso hoy hemos tratado de, al menos, tratar de ayudaros a encontrar algunas soluciones que puedan funcionar en un entorno tan complejo como el que estamos viviendo. Para ello, hoy contamos con 6 ponentes de máximo nivel, 6 gestores que os hablarán en una primera intervención sobre 3 de las que hemos identificado como las grandes megatendencias que van a estar presentes los próximos años, y después tendremos ocasión de debatir pues sobre el mercado que nos está tocando vivir y las oportunidades que seguimos encontrando a pesar de los disgustos que nos están dando estos mercados. Yo creo que antes de empezar es importante que todos mantengamos en la mente pues, esa visión de largo plazo que está en el ADN de Franklin Templeton. Como sabéis, basta con echar un poco la mirada atrás hacia los años pues, más recientes, no hace falta irse muy lejos. Tenemos la crisis del COVID, tenemos la crisis financiera de 2008 y para los que somos un poco más mayores todavía recordamos la crisis de la burbuja .com. Esto nos hace tener presente pues, que al final los mercados se mueven por ciclos y que, gracias a Dios, ningún ciclo bajista ha durado eternamente. Esperemos que este tampoco dure mucho más. Sin más, recordaros que el evento o la jornada cuenta con 2 horas de recertificación EFPA y para todos aquellos que contéis con la acreditación, por favor, deberéis dejar los nombres en la mesita que encontráis en la entrada. También recordaros que tenemos un desayuno y que cualquier pregunta o información que queréis que os ampliemos después del evento, pues estaremos a vuestra completa disposición. Sin más, como no habéis venido hoy a escucharme a mí, vamos a empezar con la ponencia de hoy, que será Matt Mover, que es nuestro gestor del Franklin Innovation Fund. El Franklin Innovation es un fondo cuya versión americana cuenta con más de 60 años de histórico y además tiene más de 20.000 millones de dólares en activos bajo gestión. Es un vehículo que decidimos traer a Europa hace ahora 3 años y tenerlo en formato UCITS para tenerlo a disposición de todos sus clientes. La tendencia, yo creo que el enfoque de invertir en tendencias es algo que ha venido para quedarse, lo llevamos viendo durante los últimos años. Ya no basta con invertir a nivel regional como hacíamos la década pasada, ahora hay que hacerlo de una forma mucho más transversal, con la mirada puesta de forma intrínseca en el largo plazo, porque son muchos los cambios que estamos viviendo, cambios demográficos, tecnológicos, económicos, y alinearse con estos cambios nos parece una forma bastante acertada a la hora de configurar cualquier cartera de un cliente. Sin más, doy paso a Matt Mover. Matt, the time is yours. Gracias.
Great. Well, thank you. It's great to be up here today. Great to be able to speak to you. This is actually the first time that I've ever been able to speak to this audience here in Madrid, because, as was mentioned before, although this fund has been around and was founded in the United States in 1968, it actually only came in a UCIT or a CCAP strategy in 2019. So, and then of course COVID hit, which was a great beneficiary of the fund, but didn't benefit me coming out to be able to speak to people like you. So it's really great to be here today. This fund, as I mentioned, has over 54 years old. It was actually founded by our vice chairman, Rupert Johnson, and what he had was he had this idea that investing in innovation is one way in which to, let me make sure this clicker works and I'm going the right way. That investing in innovation is one way in which to outperform the market over the long term. Because really it's innovation which creates wealth in the economy. Now in 1968, this was actually a very prescient idea. In other words, Silicon Valley wasn't called Silicon Valley until 1971. And the venture capital community did not start until 1972. That's when Kleiner Perkins and when Sequoia. So really the idea of this fund was very much at the zeitgeist of the time of this idea of investing in innovation. So there's a few key tenets that I want to speak of that I think have lasted over the entire period of this fund, and that is innovation in the economy is accelerating. When we think about innovation and what was happening in the 1970s, it was in very small parts of the economy, although meaningful. It was in jet travel. It was in defense and semiconductors. It was actually in instant photos and beauty care. And today, it's really accelerated to be a much larger part of the economy. And we really believe that what we are in is the beginning of the fourth industrial revolution. And so what are some signals that we're in the fourth industrial revolution? The first might be that in the US, in the S&P 500, the average company has a life. In 1964, the average company in the S&P 500 was in it for about 33 years. By 2027, it's estimated that it'll be about 12. Now, how do you have change in the S&P 500? It's really in two ways. One, of course, is companies need to fail. And we think we're going to start to see that in an accelerating rate, because when you go through something like the fourth industrial revolution, revolution is not a word that we use lightly. It actually means a lot of companies that used to have very, very stable business models will get disrupted. Certainly, we're seeing that in television with over-the-top programming and things like that. And so we are also, the other way in which you get into or become a company in the S&P 500 is in a very short period of time, you create a tremendous amount of wealth. And I would argue we're seeing that today. So we compare this period that we're going through is very similar to what we went through in the second industrial revolution. During that period of time, we really had a handful of technologies all happen at the same time. And those technologies that happened at the same time were electricity, telephone and telegraph, indoor plumbing, and then, of course, the combustible engine, which led to the advent of the steel industry, rubber, train, etc. And so when you fast forward that to today, we also think that there are these platforms of growth, which I will talk about. But we think we're experiencing that. I think another symptom of this idea of the fourth industrial revolution is the idea that there have been a lot of huge companies created in a very short period of time. So when you think again about the second industrial revolution, you think about the biggest names of those times, and I happen to be a little bit US-centric or US-based. I would say the biggest names at that time were Rockefeller, Vanderbilt, certainly Carnegie Mellon, Ford, etc. Today, the names are different, but they have also created companies larger than anything we've seen in history. And the names of those companies, or the founders of those companies, are Bezos and Musk and Zuckerberg and Gates. You can only have that when there's a true technological advancements coming to displace. And so if that happens, I think what matters is that you have a mindset where you understand that mean reversion investing, which worked for the past 70 years, is less likely to work, or certainly a lot more dangerous because you have companies fail. And at the same time, you're going to have companies that succeed dramatically. And so that's built into our philosophy and our process. The other thing that I've learned, and I've learned by being on this fund, I started on this fund in 2004 in the US. And so Rupert and I have been working together for 18 years. I started the firm in 1999. And that is this idea that innovation demands active management. I think one thing that has surprised me during my journey is if I was asked when I started my career about where are the biggest mispriced assets in the economy, I probably would have said small cap, because those aren't covered by anybody. And then I might have added another layer and said emerging markets small cap, because that just doesn't get the same amount of coverage. I think what I would not have said, and I have no opinion on that, that may actually be academically correct, but I probably would not have said, well, it's obviously the most covered companies in the world from a media perspective. But in fact, through our experience, that's exactly what's happened. And so one thing that sort of I learned through Rupert on how to invest in innovation is how to identify these companies as early as possible and how to build a process and a framework in which to invest in them. And so it turns out that one of the most mispriced parts of the market is actually in innovation. So as mentioned, I started in 1999 here, and I was lucky enough to start as the internet analyst. And when I started as the internet analyst, I happened to cover Amazon.com. Amazon.com, just like today, was in the news every single day. And every single day in the popular press, it was an expensive stock. In fact, to the point where I used to say, this should be Amazon.com, a very expensive stock, did the following today. Because there was all this commentary in the popular press about how expensive it was. It actually turned out to be one of the better investments over the past 20 years. The same is true with Netflix. The same is true with Tesla. The same has been true with Google. And so I keep on my wall a Barron's article where they called Google gurgle and said that it was in 2005 and said that it was about to take on water and all the click fraud was going to make it worthless. And so there's tremendous misunderstanding of how innovation is priced, and we try to take advantage of that. In general, we find that the duration is misunderstood, and that means that these companies grow in excess of GDP much faster than expected. Salesforce.com has yet to have a year where they post less than 20% growth since it went public in 2004. That includes the financial crisis. And so I would argue that most people didn't have something like that in their model. When we talk about sort of what is the foundation for all this change that's happening in the economy, I think the simplest way for us to think about it is this idea of bite, atom, and gene. For the first time in history, we are able to manipulate things on their most base form. And that means the price of data is now moving towards zero. It also means, and that means we are able to create data, transfer data, securitize data at a price of zero. And when that happens, a whole new group of innovations start to come out. You start to be able to do artificial intelligence, machine learning, virtual reality, augmented reality. Quantum computing becomes more relevant because you have more use cases, and certainly cloud computing, simulation software, et cetera. The same is true for the atom. We are able to actually create new elements at this point. When we talk about semiconductors, we are getting down almost to the atomic level of width within semiconductors. Certainly within energy, we're at the atomic level and have been for some time. And so we're able to manipulate things on these most base forms, and that creates another platform. And then lastly is genomics. We are now able to sequence the gene for well under $1,000, and we think that opens up an entire new industry. There's a couple things I would highlight with this. It's across everywhere, meaning one might be a little bit more tech, like in the bite. Atom might affect more the industrial or energy space, and genomics might affect healthcare or agriculture more. But you're talking about something that goes across the entire economy. And that's how we try to think of innovation. We try to think of innovation everywhere. The last thing I would say on this is that when you look at this slide and you go across, and you think about what are the big trillion-dollar companies in Byte that are benefiting from Byte, I would probably say Microsoft, Google, certainly one. Facebook's not a trillion anymore, but it might be in there. Amazon with its AWS probably has a $1 trillion market cap there. On the atomic level, I think you could argue that Tesla and Apple certainly are benefiting from the chips and from new energy and other things. And there's not a $1 trillion market cap company yet on the genomic level. And so when asked sort of what do you think from a 10, 15-year perspective of where do you think there's going to be a lot of growth, I would say I think there's a very good chance that in 10, 15 years, there will be a company or two in the $1 trillion market cap range, in that genomic level. I think that's an area of the economy that's just starting to open up. It makes us very enthusiastic. So investing in innovation is pervasive. It's across the entire economy. And I had mentioned sort of this idea of the second industrial revolution of all these different technologies that were developing at the same time. And so we sort of tried to do that here, where we said, okay, what are the really big themes that are happening and that are multidimensional and much deeper than what we might think? And we would go say there was global commerce, genomic breakthroughs, intelligent machines, new finance, and exponential data. I think what's interesting about that when you go left from right is that you're really talking about retail, healthcare, industrials and energy, finance, and technology. And so it is very much across the board. We're seeing across the entire economy. I want to mention a couple things regarding the current market environment very quickly, and that is we have seen these types of drawdowns that we've had before. What usually happens is the companies, what we look at and what interests us is what is the ecosystem underneath that is healthy, and is the ecosystem for innovation healthy? And we find that it is. This fund this year, on a fundamental basis, that means from a revenue growth rate, despite the performance of it, is actually expected to grow above 18% on a weighted average basis revenue. Now, we have watched, for example, Salesforce.com since 2008 has actually had a stock performance of a 24% CAGR and a revenue growth rate of 30% CAGR since 2008. And 4 times it's had declines of 30% or greater. And so when you invest in innovation, having swings like this is not uncommon. What matters to us is that underneath, the fundamentals are still very good. And we're finding that these growth businesses actually have very good fundamentals underneath. And just as a few examples of what's happened just recently, in August we had 2 approvals for gene therapies, one in the FDA and one in the EU, one for beta thal and the other for hemophilia. We're talking to scientists that are using augmented reality in which to do surgeries. We are actually still see a ton of innovation. We're talking to customers that still really are saying they're getting tremendous ROI by moving to the cloud. And so we understand the economic part that's going on, and we understand what's happening with the stock market. But what matters to us more is do the fundamentals underneath, meaning if I was on an island and all I was getting was 10 Qs and 10 Ks and that's all I could read and I didn't get to see the stock market, would I still feel that these companies are doing well? And we would argue that all of them or most of them in the portfolio are doing well. What we're trying to find and what we make trades on and what we sell are those that are experiencing permanent impairment. And we would argue that not a lot of these companies are experiencing permanent impairment. Now, it's great to be able to speak with you today. I really appreciate the opportunity, and I'm going to give it off to, let's see, to you.
Thank you, Matt. Bueno, pues a continuación tenemos con nosotros a Charles Hamney. que es el gestor de nuestro ClearBridge Infrastructure Value, que muchos de vosotros ya conocéis. Sabéis que si algo ha dejado claro este 2022 es esa necesidad que tenemos de incrementar nuestra independencia energética. Y aquí es verdad que la inversión en infraestructuras nosotros pensamos que va a jugar un papel clave. Para los que no estáis familiarizados con el equipo, contaros que todos los miembros vienen de trabajar del mundo de las infraestructuras no cotizadas y que a día de hoy conforman el equipo dedicado a infraestructuras listadas más grande del mundo. Otra de las cosas que ha dejado clara o en evidencia este año pues es ese papel diversificador que juegan dentro de las carteras de cualquier cliente, siendo de los pocos activos que a día de hoy están en positivo. Sin más, os dejo con Charles. Charles, the stage is yours. Gracias.
Thank you very much. Good morning. Good morning. It's great to be back in Madrid, a city that I love very much. My honeymoon happened in Madrid many, many years ago. My first marriage and my second marriage, both honeymoons were in Madrid. But I suppose today I want to talk about the asset class infrastructure and give you a bit more context as to what's driving it, how the characteristics that have been fantastic for over 20 years haven't really changed despite the nature of the asset changing, and more importantly, the type of benefits that you should see when you invest in the asset class within a diversified portfolio. And I was thinking about it last night. I've been invested now in the asset class, or involved in the asset class for over 25 years. And over the last 25 years, there's been rapid change across the asset class. But what hasn't changed is the fact that every dollar of capex that these companies spend, they're still allowed to pass through inflation. They're still allowed to pass through all those costs. And that means that you get very resilient cash flows, which translate into very healthy dividends, growing at well above inflation. So whilst the world around is changing, that constant of the characteristics and the outcomes certainly hasn't changed. And I was thinking about the first asset I invested in unlisted infrastructure, which is my background, was this logistics facility in India. It was a horrible, horrible asset. Very short duration, very volatile cash flows. But hey, this was 20 years ago, so we called it infrastructure. It's an asset which now doesn't exist anymore because it went broke, but it's an asset which now would not really fit our definition of infrastructure. And what we're seeing now is, there's a lot of words on this, so I'm not going to go through every word, but I want to point out a couple of key things. We're in a world where we're fast approaching the real need to invest significant amounts of capital to achieve that net zero. And what we do know is that the path to net zero is not going to be linear. There's going to be a lot of twists and turns as we get there. And that's important. And what's happening now in Europe really accelerates the need to not only improve energy independence, but to invest in technologies that will allow us to do that very, very quickly. And it's fortunate, I suppose fortunate you're in Europe and not in the UK, but I suppose the importance of that is that there is a huge commitment by European governments, by European regulators, and by private capital who are being incentivized to ensure that we can meet that net zero objective in a way that is affordable. Now, I quite often say to people that the requirement is trillions of dollars of spend that has to occur for us to get to net zero, changing the way we generate electricity, changing the way we move around society, changing the way we move goods around society. But what's important to understand is that there is a big cost to that. And that cost has to be borne by society. But it's a much easier cost to bear when governments push that cost down to private capital. Because private capital historically has been very good at doing two things. One, spending the capex, but two, ensuring that the cost of the service doesn't go up significantly above inflation. Even in this environment, we don't expect to be a significant increase well above inflation in the cost of delivering that service. But despite all of that, the constants. Now, I could have put this chart up 20 years ago and it would look exactly the same. Perhaps the growth would have been a bit different, but the outcomes would have been the same. These are businesses which are an essential service. Now think about Red Electrica, or Energas, companies in your home. in your home country, think about the need to move electricity, to move gas around on the transmission lines and distribution lines. Think about the fact whether you're in a recession, whether you're growing, these are assets which will always be used. And by virtue of that fact, there's a high degree of economic resilience. So if an economy is unfortunately suffering a recession, there's a high degree of stability of their cash flows. And that stability of their cash flows results in very significant ability to pay out dividends, but most importantly, dividends which grow well above inflation. It's a very unique characteristic of infrastructure when you compare it to, say, real estate assets, or you compare it to soft commodities, which are also perceived to be inflation pass-throughs. When I think about inflation pass-through, I think about three key things that drives that mechanism. One is the pricing mechanism, two is the market structure that the asset operates in, and three is the demand volatility that that asset or that company has. Now think about infrastructure. You have a pricing mechanism which is regulated or concession agreement with a very clear mechanism to pass through inflation in the asset base or in the allowed return, inflation and interest rates. You have a demand volatility which is very, very low by virtue of the fact I explained earlier is an essential service, so you will use the asset irrespective of the economic environment. It has a very low elasticity to economic outcomes. And then you have a pricing or revenue mechanism, again, which has very low volatility of outcome. Now think about property trusts. Property trusts or real estate assets, which also are perceived to have an inflation pass-through. You have a market structure which is increasingly very competitive and supply and demand driven. And you have a pricing mechanism, again, which is increasingly very competitive. And you have demand volatility, depending on the nature of the asset, which is moderate to high. And then you have soft commodities or agriculture, or even general commodities, where on every one of those measures, it's supply and demand driven. And I often say it's very easy for a landlord or anyone to pass through inflation when it's 2 or 3%. But good luck when it's 6 or 7% or even higher in the case of some other countries. And we're quite blessed in infrastructure that the nature of the asset class does allow it to be a very reliable hedge against rising inflation. And finally, because of that, because you have an asset class which is an essential service, you have an asset class where you have very high resilience of cash flow. You have an asset class where inflation is passed through directly and indirectly, and without fail. You're able to get really strong diversification benefits when you include the asset class into a portfolio. So not only at the beta level, so the asset class has a much lower beta than the general market, but the nature of that beta is what's most important. In very volatile markets, as we have seen in the last year or so, and going back over the last 20 years at various times when you have significant drawdowns, the asset class really is able to preserve capital in some cases, or not participate in as much as the downside as general equities. Yet when the market is rising, the structural growth of the asset class, the asset-based growth of the asset class, which underpins that growth, means that the upside capture is also very, very attractive. And when you combine that with the scenario we have now, where we see significant growth in the asset bases of these businesses, it's going to be very powerful to leverage that going forward. Now, when I talk about significant growth, obviously you have the secular growth story of decarbonisation and what that means for the asset class, but even little things like improving transmission and distribution lines, improving access to water, improving roads and airport infrastructure. There's a whole series of general maintenance that's required in infrastructure to make sure the asset works. So when all of us turn the lights on, the lights come on. So that growth is the structural organic growth. And that's the growth we've seen over the last 10 years. To put it into context, now, US utilities are a really meaningful part of our universe. Over the last 15 years, the average US utility has been able to grow its asset base by almost 8% per annum every single year. Now, these are utilities. They provide basic things like electricity, gas, and water, growing at 8% compound per year. They've been able to achieve that growth and earn an allowed nominal return on equity of 10% per year. So imagine that. For providing a water or gas or electricity to all of us, these utilities have grown their asset base and earned 10% for every dollar of capex they've spent. That has translated into some very, very powerful outcomes for shareholders and equity holders. Almost 13% total return every year compound for the last 15 years, investing in an asset class that is an essential service. Now, going forward, if we think about asset-based growth and why we're sort of so excited about the net zero There's no asset class more at the forefront than delivering on that net zero policy goal than infrastructure and utilities. It's a very simple mechanism. You have governments saying we need to achieve net zero. It's going to cost $1 trillion a year. The governments turn to the regulator and say, make it happen. Incentivize private companies so they can spend this money. The regulator then turns to private companies and says, okay, well, what do you need in terms of return to ensure that this money gets spent? No more is that powerful now than in Europe. You know, the need to achieve independence of your energy, to pull forward trillions of dollars of capex, and by pull forward I mean by 2030, across the whole supply chain, from renewable energy, so wind, solar, to hydrogen, to LNG. There's a need to spend significant capex. And all that capex will be done and spent in a regulated environment. So companies will earn an allowed return for every dollar of capex they spend. And again, that relationship between earning an allowed return, growing your asset base, and flowing that up into very high cash flows, very strong dividends, and dividends which grow well above inflation, that will hold. And we're fortunate now that because we have this supernormal growth, which will last for the next 20 years, we're very confident that that relationship will continue to hold across the sector. And these are some numbers which talk about the amount of money that needs to be spent. And one thing I've realized in being an investor for 20, 25 years in infrastructure is that we always underestimate the amount of money that needs to be spent. And I think we'll do the same, you know, talking about at least $1 trillion every year for the next 10 or 15 years, all designed not only to achieve that goal of net zero, but to pull forward technological advancement. And it won't be linear. I made that point earlier. It won't be linear. So it's very important, being a listed investor, when you invest in these companies which are benefiting from single projects, that you do have the ability to exit if you get it wrong, because, as I said, it won't be linear. But we're very excited at the moment, being a listed investor, because a lot of this expenditure needs to happen in core infrastructure and utility networks. So core utilities, core electricity generation, renewable assets, core parts of our user pays system, so toll roads, airports, freight rail, passenger rail. And that's the sweet spot of listed infrastructure investments. Certainly, in direct investment, you can get access to other assets, more competitive assets or more social assets, and on occasion, you will also benefit from, you know, specific assets in decarbonisation. But as a whole, a lot of this spend will happen in listed infrastructure. And importantly, governments have no money to do it. So that policy goal is going to happen. We will get close to decarb or net zero by 2050. And private capital really will be turned to make sure that we deliver the bulk of that investment. And I spoke about that already. Now, this is the outcome I was talking about earlier. And you can see that, is there a pointer here? No, there is not. You can see that one of the key things of this sector, and this is well over 10 years of data, and you can go back even further than that, is the ability of a sector to, in really volatile markets, falling markets, to preserve capital. And this is important because I quite often say the one way to make money in the long term is to avoid losing it in the short term and then to compound the attractive characteristics of infrastructure over the medium term. Yet when markets are rising, you know, the ability of a sector to participate in the upside is also very, very strong. So if you think about it, you have an asset class, and by virtue of the fact it's an essential service, which is very defensive, and you know, there's been many, many instances over the last 20 years where that's been proven, including, you know, more recently. But when the markets are rising, you're able to also capture in the appropriate upside. Now, add a layer of active management over that, which is, you know, what we do in terms of absolute return, active management, that's even more powerful. So you get to the same point relative to global equities over the long term, but you do so in an environment where you have significantly better risk-return outcomes. And again, when you add a layer of active management over that, really amplifies those outcomes significantly. And these are some of the thematics that are really flowing through a portfolio at the moment. And I quite often get asked, is it the right time to be an infrastructure investor given the really, really strong returns, you know, the various funds have achieved over the last 10 years? And I have to sort of reply by saying that there really is no wrong time to invest in the sector, because a lot of these drivers are very, very long-term in nature. Obviously, the decarbonisation trend and what needs to happen there, I've spoken about that. You have significant capex all being spent by a handful of companies, growing their asset bases, you know, resulting in really powerful outcomes for investors. global utilities more generally, not only are they leaders in clean energy, they're changing their businesses, but they're doing so in the environment of being regulated. So there's little to no risk in that change. Think about, California utilities. When those EV charging stations are built, a lot of that goes into the asset base of these companies, and they earn a return on that, not only in California, globally. Think about a utility having to strengthen a transmission line which connects to an offshore wind facility. All that capex goes into asset base, and they earn a return on it. So it's very important. The last two are also very important, the evolution of 5G, the way we communicate with each other and what that means. Obviously, there's multiple ways to play that. But for us, the best way to play it is to be the owner of the asset. To own the tower companies, they get paid to put equipment on their towers from telecommunication companies. The outcome is the same. They're right at the forefront of delivering on that goal of evolving the way we communicate with each other. But again, they do so in an environment where there's much more resilience and predictable outcome to their cash flows. Now, just before I finish, there's one more point I'd like to understand that right now we're in a very unique part of the market where you have a huge amount of money that's been raised in unlisted infrastructure, $300 billion US, waiting to find a home. There's no assets left in core infrastructure, so utilities and user-pays assets. So increasingly, a lot of these companies are looking to the listed market. So they're taking over companies in the listed market, and we've benefited from that. But they're also buying non-core assets from many listed companies, which allows these companies to then reinvest in their core businesses, grow their assets, and take advantage of what they see in terms of decarbonisation and what that means. I want to wrap up before I'm out of time. I'm an Australian, so I talk a lot. But I wanted to wrap up with one last point before I finish. Now, I made the point earlier that you've seen massive technological change. Now, I asked last night what the tallest building in Spain is, and it's a building in Madrid. It's 250 metres high. I forgot the name of it. Now, over the last 15 years, what I've seen in terms of a technological change in my sector, so you've had a typical wind turbine facility was between 80 and 100 metres high, and the wingspan was about 150 metres across. It would generate around 3 to 4 megawatts of electricity per facility. Roll forward to now. I visited a facility just pre-COVID, which is now being finished, where the height of the tower is almost 300 metres high. So 50 metres higher than the tallest building in Spain. The wingspan is 400 metres. And each one of these units will generate 15 megawatts of electricity. So the technology is there to really accelerate this push towards decarbonisation. And as I made the point earlier, as that technology evolves, a lot of that is being spent and delivered by listed companies. So as listed investors, and I can see some very familiar faces, and so thank you for your support. As listed investors, we are really going to have the opportunity to invest in significantly high quality assets in frameworks of regulation which will incentivise returns for many, many years to come. And that's why I'm so excited about the sector. But thank you so much for your time. Thank you. Thanks, Craig.
Thank you. Bueno, pues por último tenemos a Craig Cameron. Craig es el gestor de nuestro Templeton Global Climate Change. Para los que no estáis familiarizados con la estrategia, el fondo lo que busca es invertir en aquellas compañías que tratan de encontrar o de ofrecer soluciones para luchar contra el cambio climático. La principal diferencia del fondo es que es un fondo que se gestiona con un enfoque de gestión value, muy centrado en las valoraciones, y esto se refleja en que al final sus ratios de valoración son significativamente menores a los de la media de su categoría, donde las valoraciones están bastante más elevadas. Para nosotros, en Franklin Templeton, nuestro compromiso con las emisiones cero en 2050 es una clave en nuestra agenda, y por ello creemos que una estrategia como esta pues debería tener sentido en cualquier cartera que se gestione con una visión de largo plazo. Muchas gracias, Craig. The time is yours. Gracias.
This is falling off. Nice start. Okay, I'm going to reattach this first. I guess I want to start by saying thank you to these guys because they've kind of set it up for me, talking about the innovation and in the economy. and infrastructure and everything that's going on today. And so I want to talk to you about the very specific theme that I think everyone referenced, which is climate change. I think climate change is the area that offers us the most exciting opportunities today. And I also think it's going to be the leading driver of industry change over the 2020s. I was going to say I didn't have even one honeymoon in Madrid, so I don't have a story to start off on that one. But I did do my anniversary in Madrid this weekend,
There you
so
go.
I hope that counts. So I don't think you need me to tell you that climate change is having a massive impact on the global economy. We talk a lot about trying to hit a Paris Agreement goal of limiting warming to 1.5 degrees. But I think what we often overlook is that today we've already used up 1.2 degrees of that. And actually that's already having a huge impact, whether it's extreme weather conditions, so wildfires in California. I was reading that in Madrid this summer it was more than 40 degrees Celsius. Pretty much every country in Western Europe had a new record temperature this summer, and we're only at 1.2. So I guess what I want to start by saying is imagine a world where we only limit warming to 1.5 degrees and realize that we will see more extreme weather events and worse conditions than we have today. And that actually kind of puts in perspective what might happen in a world where we can fail on those aspects, and we end up with 2 degrees warming, or 2.5. And actually, when we think about the various scenarios that are in front of us, I would argue that the 1.5 degrees that we aim to limit warming to in the Paris Climate Agreement is the least disruptive option. This is the environment that's closest to where we are today. This means we need to adapt less as society. We're going to see a lot less mass migration events as the core of equator sort of regions see drastic temperature rises. And actually, that's the safest option for us as society. And so it's clear that whatever of these scenarios, whether we're in a 1.5 degrees warming, a 2 degrees, or 2.5, we're going to see huge structural change. Now, if we take the IEA's net zero, which Charles nicely referenced for me as a sort of warm-up here, this is net zero by 2050, and this is their flagship report. So this is what needs to happen by 2030. That's this decade, and in fact, that's only 7 years away. It gives you an idea of just how much change we need to see in this decade. We're already more than halfway between the Paris Climate Agreement of 2015 and 2030, when all of this needs to happen. And you can see here some of the usual suspects. Electric vehicle growth goes from 4% of global car sales to 60%. You see renewable energy increase more than 4 times. And in fact, global coal demand needs to fall by more than half of the 2020 level. And these are just over the next 7 years. So my pitch to you is, I want to own the companies that are benefiting from these massive shifts in all of the various industries. And it's not just about renewable energy or electric vehicles. If you look at electricity investment, transmission spend, that needs to triple. CO2 capture goes from essentially a non-existent industry today to capturing nearly 400 million tons of CO2 per annum by 2030. And there's more. We need all buildings to be zero carbon ready, and we need to be demonstrating new technologies in heavy industry, so decarbonizing things like steel or iron production at scale by 2030. And it's clear that this impacts every single part of the economy. This is about changing the way that we manufacture materials, changing the way we travel, changing the way that we make the buildings that we live in, and even changing the way we eat. So how do we find those companies that are having that impact and helping to decarbonize society? Well, I like to think of this iceberg as the impact that a company can have on the environment. And so the bit that's really obvious is the bit above the water. So scope 1 and 2 emissions. That's from the factories that a company has and the electricity that they use. And it's the really obvious bit that we think about and we focus on a lot, and we want these companies to help reduce their emissions. we spend some time thinking about scope 3 emissions as well, life cycle emissions. So the supply chain, manufacturing of the materials, or processing of materials before they reach the factory. It also includes the use phase. So for example, when you drive around a car, that would count as the scope 3 emissions for the auto manufacturer that you purchased the car from. But I think what we forget about or spend not enough time thinking about is what we call scope 4 emissions, avoided emissions. So if I'm a company that can install a product that helps to reduce the emissions in society, I'm having a positive impact on our environmental challenges. Take, for example, a company that can install a low-energy light bulb. This helps us to use less energy. These are really bright, so probably we're using just as much. But you're talking about 90% reduction from a traditional bulb to a modern-day LED. That is helping to cut electricity use. And actually, when we look back, lighting has fallen from about 20% of electricity to about 10% today. That's a huge reduction in energy usage associated with lighting. If I'm a company that is installing, let's say, a wind turbine, that is offsetting gas use or perhaps other fossil fuels in the electric power grid. And I'm actually having a positive impact by reducing the emissions in the economy. So here's how we think about scope 1, 2, and 3 versus scope 4. So these are some company examples. What you can see on the left-hand side, the gray bars are the scope 1, 2, and then in a lighter gray scope 3. And then the green is the scope 4, or avoided emissions. And these are 3 examples of companies that have already calculated this data. They report this publicly, and we have sort of also taken a look at their assumptions and feel confident showing you this data on the slide. And what I think is surprising is all 3 of these companies are having a positive impact on the environment. Their scope 4 emissions are greater than their scope 1, 2, and 3 combined. And actually, we learned some interesting things as well. So, for example, if we just look at scope 1, 2, and 3 emissions, Vestas looks like a way better company than Prysmian. We have 4 versus 18. But when you add in the avoided emissions, you find that Prysmian, the world leader in copper cabling, is actually having a more positive environmental impact than Vestas, the world leader in wind turbines, and voted the world's most sustainable company. So I think this is a differentiated way to think about the industry and think about the ways that companies are helping to reduce emissions. And it also means that we're willing to accept some higher scope 1, 2, and 3 emissions if a company is having a huge impact on avoiding emissions in the economy elsewhere through their products. And the money is being spent. So Charles mentioned this already earlier, but by some estimates, we need to spend $4 trillion a year just to help decarbonize society. And actually, just this year alone, the US announced the Inflation Reduction Act, $369 billion of incentives and subsidies to help spur growth in clean energy, electric vehicles, solar, wind, and hydrogen. The same is happening in the EU through the Repower EU scheme, and we're also seeing a similar level of spend in China. And again, these subsidies are designed to encourage that private capital that we were just talking about to invest huge sums of money in these projects. So I'll leave you with my sort of opinion. I think that climate change is the main driver of industry change during the 2020s. And I think that by looking at avoided emissions, we can focus on the companies that are having the most impact. They're helping to decarbonize the economy. They're providing what we might call the picks and shovels to help achieve that low carbon economy by the 2030s. And actually, a combination of regulation and huge demand growth should provide a very strong tailwind for the kind of companies that we want to invest in. So I'll leave it there. Thank you. I'm not actually sure if anyone else is coming up, but
She's coming now. It's like a Broadway production. Yeah, no. Thank you. Stage right.
¿Tengo sonido? Sí. Vale, pues hoy muchas gracias a todos por venir. Yo soy Nicolás Peña, director de ventas, uno de los directores de ventas de Franklin Templeton en España, y voy a ser el moderador de la segunda parte de este evento. Espero que os haya resultado interesante. Yo he escuchado los dos primeros y la verdad, innovación, cambio climático, infraestructuras, son las tres ideas que más hablamos en todas las conversaciones con vosotros, o sea que espero que os haya interesado. La segunda parte va a ser un poco distinta. Hemos traído 6 gestores a este evento, queríamos hacerlo en hora y media, hora 3/4, no más, porque sabemos que estáis muy ocupados. Entonces, ahora vamos a hacer un pequeño panel, una mesa redonda, con 2 gestores de renta fija y un gestor de renta variable, donde la idea es hablar lo hemos titulado «Cómo conseguir alfa en un momento de alta volatilidad». Conseguir alfa en un momento en el que la bolsa lleva un -20 este año, la renta fija, si miramos el Global Aggregate, lleva otro -20. Es algo difícil, pero para eso tenemos hoy a nuestros 3 gestores que nos van a ayudar. Tenemos a Will Bond de Brandywine. Brandywine es una de nuestras gestoras de renta fija. Brandywine, sobre todo para nosotros, para esta oficina, gestiona un fondo que es Brandywine Global Income Optimizer, que es nuestra estrategia flexible y global. Flexible probablemente es algo que necesitemos hoy en día para conseguir alfa en mercados como estos de renta fija. Tenemos a Derek Deutsch de Clearbridge. Clearbridge es una de las gestoras de referencia en Estados Unidos en renta variable ESG. Clearbridge es Charles, quien habéis escuchado ahora, el gestor de infraestructuras. Derek gestiona el Clearbridge US Sustainability Leaders. Entonces, para nosotros esa es nuestra estrategia de renta variable USA desde un punto de vista sostenible, algo que vosotros miráis hoy en día. Y el tercero y último, David Zahn, es nuestro responsable de renta fija europea dentro del Franklin Fixed Income Group. Dentro de los fondos que gestiona hay una estrategia que seguramente conocéis, que es Franklin Eurosor Duration. ¿Por qué Eurosor? Porque es lo que más nos habéis estado preguntando. Es uno de los fondos que es, si no primero su categoría, entre los 2 o 3 primeros a casi todos los periodos, y por el momento de tipos de interés donde estamos, es algo de lo que vamos a hablar mucho. Entonces, con esto yo creo que ya empezamos y pasamos al inglés. So we switch to English for the questions. So first question will be about economy. So when we manage markets, we have to look always the economy. So I was saying that equities are 20% down in 2022, but bonds are 20% down as well in 2022. So economy, we have inflation, central banks tightening, increasing rates. So what can we expect? We see many analysts saying that we are entering into a recession. So your view probably will, how do you see that?
Yeah, no, well, thank you very much for having us today. It's great to be here in Madrid. One of the biggest disappointments are when anyone sort of sees my business card and sees that it comes from Brandywine, and I'm not involved in brandy or wine, and I'm a bond manager. You can see the sort of look drain out of their face. But it's, we said it's great to be here, but it's been probably one of the hardest sort of years for sort of managing bonds, but it's why it's been so important to be flexible over these times. Talking about sort of that sort of recession, like we feel that every macro indicator that we look at is sort of pointing to global PMIs down into the 40s. But I think the one thing that's sort of keeping us from sort of really pushing down towards that big recession call is where credit spreads are, and in particular, those US credit spreads. And so we feel that it's that pushing out of maturities, the strong corporate balance sheets, that's at least sort of postponing that view. But we feel that with the Fed aggressively pushing on the front end, something's going to break. And at 3.6, we're starting to find that long end of the Treasury very, very attractive. We're not quite ready to sort of go full sail into that duration sort of call, but it's where we've been carrying a very high cash balance this year, and that's where we would be looking to deploy amongst other places.
Okay, good. Derek.
Yeah.
From a US equity investor, how do you see that?
Okay. So, buenos dias. It's great to be here in Madrid, so thank you for having us. So, I'm just a portfolio manager. I'm not a macroeconomist, but I will let you know what we're thinking at ClearBridge. So, we have developed our own proprietary model to kind of help us predict the economic environment that we're likely to be facing. And it looks at a number of different factors. It looks at financial conditions, business activity, consumer conditions, and we've been following these metrics over many years, and it's quite predictive in helping us understand where we're going. And as of the end of last month, it is showing that we are more likely than not going into a recession. I don't think that is going to surprise anyone in the audience. We are putting the odds of that at about 75%. So it's not 100% certainty, it never is, but there are a few things that we're looking at that we think could perhaps help prevent us from going into a recession or a deep recession. So the first thing is that if we look at sort of inflation, right now it's potentially peaking. If it does start to come down more aggressively than people are anticipating, and the Fed, and we're seeing supply chains start to ease, so that's helping, oils come down. So if that continues to happen, perhaps even at an accelerated rate, then we might be in a position where the Fed can stop being as aggressive and perhaps even pivot to a neutral or a more dovish stance. So that's one possibility. And the other thing is that the labor market continues to be quite strong. You talked about credit spreads, but in addition, we're still creating jobs in the United States. The unemployment rate is still very low, so it's unusual for us to be in a recession when that's the case. One thing that we're looking at quite carefully is initial jobless claims. So we're coming off of 50-year lows on that figure, and we're still at a very low level. So the last reading, I think, was about 215,000. Where we will get more concerned is when we get to 300,000 and above. So that's one of the things that we're watching, but as of now, I think more likely than not, we'll be facing a recession within the next few months, if not the next few quarters.
So 70%.
75%, yeah.
Because people like numbers. So David, do you have a number?
98%.
Really?
For Europe,
That's
yeah.
For Europe, okay.
Yeah, I think in Europe, we will have a recession starting either later this year or early next year. It's really based off of a couple of different factors. The ECB is raising rates, yes, but the bigger issue is inflation is so high. We're going to probably have gas rationing this winter, which will hit the economy. I don't think it's going to be a bad recession. I think it'll be a mild recession. And why is that? Because I think that you'll see a big fiscal impulse coming from the governments. They will spend more money. The EU is really getting used to spending money. They will spend more money. And I think this will keep any type of recession we have being quite mild, which is one of the reasons why we think that investment-grade credit in Europe, especially in the short end, is probably one of the best opportunities at the moment because it's pricing in a recession already, unlike the US. And we think that this is because people have left Europe for various reasons, and also there's just a lot of strain in the market. You're seeing dislocation in the government market as well as the credit market, and this is a place where you can buy bonds that are 3 years that are yielding 3.5%, almost 4%. And we think if you think of what is the world going to look like over the next couple of years, that's probably a really good place to be investing at right now.
So, recession, okay. 98, 70, probably recession. So okay, we accept, we enter into a recession, and we see that governments and central banks, they cannot do many things because of inflation. Well, probably with the exception of the UK, and probably you, David, you could say something later about the huge tax cut we've seen in the UK. And probably you can say something about Italy, that they recently went through elections. So if we talk about central banks, we can start, Will. So the Fed hiked 75 basis points. Mm-hmm. They will hike another 75, 50, and probably 25. So what do you think? Do you agree with what the market is pricing for the Fed? Not? And how would you play that?
Yeah, so I think you sort of laid out fairly well where the market is looking at the sort of Fed hike. So I think we're looking. It's important to remember what the Fed is actually looking at. On that, we talked about the sort of very sort of low levels of unemployment. So 3.7 is very rare to go into that sort of recession with those levels of unemployment. You look at the sort of housing sort of levels while the sort of underlying second derivatives are starting to roll over. Still strong balance sheets. You've got 6% mortgages, but you're in a position where most people are in a 30-year fixed type of structure. So while there's a huge doom and gloom that you've got, the 30% correction in housing needs to occur to keep that affordability, we feel that the sort of US balance sheet and consumer balance sheet is very, very strong. You've got the top 2/5 of the US economy in sort of households consuming nearly 70% of consumption. Again, a very insulated sort of part that although we see the Fed pushing and we continue to see them pushing, we feel that until that sort of housing and unemployment starts to crack, you're not going to see the Fed back off. So that's sort of one scenario that you have the Fed pushing and pushing on that front end, keeping that curve inverted, and that something is going to break is probably that sort of key scenario that we expect to play out. The other is that you actually get to a November that those underlying factors start to deteriorate more rapidly, and the headline figures are now starting to slow as well, and you get the Fed becoming more data dependent. That's our sort of second scenario, but we think less likely. So it's that first scenario of that Fed looking in the rearview mirror, confusing sort of Volcker and sort of Volcker's 70s and 80s with today, where actually if you look at the difference between Fed fund rates and the market rate, 5-year sort of bonds, and that 5-year sort of swap rate, there's a significant spread there, and we feel that that's the market saying that the Fed may break things, but you've got this, guys. And it's those inflation expectations, those Michigan surveys, which we see sort of on that sort of downward trajectory, that perhaps sort of fills us with more confidence that you might not have to keep sort of hiking into the sort of front end of next year.
Okay. So David, I was going to ask you about Europe, but I remember that I read last week the Sonal Desai, our CIO for Franklin Fixed Income Group, saying that probably the rates in the US will stay high longer than the Fed thinks. And that will probably create more pain to the market. Do you agree, of course, that's the job group. Can you comment?
Far from me to disagree with my CIO. But I think that in general, yes, we think the Fed will hike to 4.5, and that rates will stay up there for a while. The curve will invert, but we probably see more yields to rise in the US than other houses. And I think it's just because we think inflation is more embedded in the US. Inflation is different in Europe than the US, but in the US, you're seeing the labor market strong, as has already been talked about, but wage increases are doing quite well. And also, the US tends to be a very insulated economy. It tends to create its own inflation. It doesn't tend to import a lot of inflation. And so that's different to Europe, where Europe tends to import inflation, is very bad at creating inflation. And so far, wage settlements have been really quite low. They've been like 3-4%. So they're not enough to keep this inflation going. And also, Europe has been hit by energy. I mean, that's obvious, so I don't need to really go into that, but that is really the main catalyst. It's been an external shock. It's not a demand-driven inflation.
Okay, so Europe, probably if the UK, so Europe, 3 rate hikes, and then more and more during 2023.
Yeah, we think they're probably going to hike to about 2%, probably by the end of this year. It's not really a surprise. But we do think that we will be entering into a recession early next year, and then it will probably make them pause, just because they will say, well, our longer-term forecasts are showing inflation is going to come back down to 2% in 2 years. Also remember, the ECB was just doing quantitative easing 3 months ago, and now they've already hiked by 125 basis points, and they will have hiked by probably 250 basis points by the end of the year. That's a lot of tightening for you to be entering a recession early next year, and then those rate hikes will hit later next year, end of next year. And so really they're putting on the brakes hard when the economy is already slowing against something, inflation that they really can't control. And so I think from that perspective, they will pause. And then I think it could be a long pause. Or they may start hiking a little bit after that. But I think in general, it'll be a long pause. They will stay there for quite an extended period of time. And then they'll start cutting again. Because I think they'll realize they probably did a bit too much. But a lot of that depends on what the fiscal dynamic is. If we see a big fiscal ease in Europe, which is definitely possible, then it probably means they will have to do more on rates, just like in the UK. We saw a fiscal ease. It probably means the Bank of England needs to hike rates more than they probably would have expected prior to that fiscal ease.
Okay. And what about the UK? I mean, we said the ECB, the Fed, they cannot do anything, or they are not doing anything, or the governments, because of this inflation. But we've seen in the UK, the government just announcing this huge tax cut. And we've seen the pound going to 105 versus the dollar. So how do you see this tax cut? Will it create more inflation? Will it be good for the average UK citizen?
Well, I think tax cuts are always the devil's in the detail, and so we have to do probably a bit more analysis on that. Just to put the spending cut or the tax cut into perspective, they're doing 60 billion, fine. During COVID, they spent 400 billion. And so I think a lot of people are making a lot of noise about this. And I'm not saying they shouldn't have spent the money on COVID during that, but it does kind of make you wonder, why are we so upset about 60 billion that markets going completely insane when 400 we just said, that's fine. So I think from that perspective, there will be more. I think there's more to come in the UK, which is one of the reasons people are concerned, because the new chancellor said that there will be more tax cuts coming in November. But I do think this loosening of fiscal does mean that monetary policy has to go a bit tighter. And so we probably will see tightening of policy a bit more. But remember, the UK is in recession already. It's the one economy that is in recession, almost assuredly. And they still have inflation at 10%. So many of the policies they put through with capping gas prices will bring down that inflation, at least officially. And I do think that will help the Bank of England say we don't need to hike as much on that. And they also don't want to overhike and crash the economy, because there's a real risk you could see that in the UK. And so it is a very fine balance, and I think a lot of people will be watching the UK to see how this plays out. And on the politics, yes, cutting taxes when nobody thought they could do anything. I think the other country we need to be careful of is Italy, because with the new leadership in Italy over the weekend, I expect that they have a huge fiscal plans. They want to spend a lot of money, but they don't have any money to spend. Because the EU won't let them. So it will be interesting. Up until now, they've been very much, let's say what the market wants to hear so that we get elected, basically. Because what does a politician always want to do? Get elected. And then they will probably start being more anti-EU over the next 4 to 6 weeks as they form their cabinet. What ministers go in will be quite important. So I think we're in for a period of volatility in Italy over the next 2 to 3 months that could create opportunities to buy. And lastly, it really brings into question, will the ECB continue to fund the Italian balance sheet as much as it has? Because remember, they're doing lots of the reinvestments are all going to Italy and Spain, but it's conditional. So if the government is not doing what the EU wants, will the ECB still buy? My contention is yes, because otherwise they precipitate a new European sovereign crisis, and they will crash the entire Euro economy, which is not something your central bank is supposed to do.
Okay. Will, you wanted to say something about
But just something again on the sort of UK, and it's extraordinary the sort of the communication strategy that the government have gone out, that the cost of lowering the sort of the basic rate of tax from 20 to 19 costs 10 times more than cutting that 45% down to 40. Plus the sort of banker's bonus at a time when there's this cost of living sort of crisis. Again, it's an extraordinary sort of communication. They sort of really focused on the supply side reforms that are being carried out and will continue to be carried out. But it's this unlimited and unfunded cap on energy bills. And the Bank of England earlier in the week, you had the sort of the split, so calling for a 50 basis point rise, but you had some people on the board calling only for a 25 basis point cut. And I think a huge amount has been sort of talked about in the press, as sort of David was saying, on this 45% rate is ridiculous politically, maybe yes, sort of communication, maybe yes, but rates didn't sell off because of that. It was a rounding error, the 40 billion and the tax cut. It's this huge, anywhere between 100 and 200 billion of unfunded sort of energy cap sort of prices that is really sort of causing that sort of sell-off. But again, as we're sort of now seeing, the UK is becoming a sort of magnet for capital-rich and sort of hungry private equity companies who've got a lot of dry powder. At near parity, there's going to be a huge sort of feeding frenzy in the UK, which the UK government have to be very careful not to sort of start saying that this isn't this wonderful, this is, the UK government, again, need to be very careful where that sort of goes forward.
Okay, thanks, Will. So we have talked about the economy, inflation. Probably the reason for inflation, especially in Europe, is energy. This energy crisis caused by this war in Ukraine. So Derek, this is for you as an equity investor. What do you think about energy? So oil was $120 in June. Today is below 80. That's really a big move. But the inflation is still going there, is still there. How do you see this energy crisis?
Yeah, so I would say the situation in the United States is obviously very, very different than in Europe. So we're not nearly as dependent on foreign countries for oil and natural gas. So we, however, do have to live with oil prices being elevated, and even though they've come down, they're still quite high. So that's a burden for consumers. It's definitely beneficial that we've seen prices coming down for about 3 months now. Gasoline prices, which is a large out-of-pocket expenditure for US consumers, has gotten to a more reasonable level. So that's good. The one thing that we're focused on in managing our strategy, so we're a sustainability-focused strategy, and we actually have an exclusion against investing in traditional fossil fuel companies. So as those stocks were doing quite well, it was a kind of a performance headwind for us. However, we're firmly convicted that over the long term, the transition from a fossil fuel-based energy economy to renewable energy is going to happen. And just recently, there was a law passed in the United States called the Inflation Reduction Act, which maybe has a little bit to do with inflation, but has a lot to do with climate change. And we are really making the most significant investment that we've ever made as a country into that transition to renewable energy. So the bill contains about $370 billion that's going to fund clean energy projects. And in the past, we have these tax credit schemes in place, the investment tax credit, the production tax credit, that needed to be renewed every couple of years, and you never knew for sure whether it would be or not by the Congress. So with this bill, we now have 10 years of visibility that those credits will be in place, and so I think that's really going to allow capital to flow much more freely into these types of projects. And we're quite enthusiastic about many of the equities that are playing to that theme. So we have no traditional fossil fuel energy companies in the portfolio. We have a lot of renewable energy, whether that's solar or wind or hydro or geothermal, hydrogen. So these are areas that we think are much better positioned now that we have this visibility into 10 years of investment that's going to be going into this area.
Yeah, I think that's really important for Europe as well, because I think that the Ukraine conflict has shown that energy security is paramount, and that's what every country is focused on at the moment. And it probably means in Europe we will have a huge increase in fossil fuel burning over the next 2-3 years. And many people have said, oh, well, that just means Europe isn't serious at actually greening the economy. But what I do think it means is, in 2035, we will be much further along at greening the economy, because by having renewables, you can actually make your infrastructure more sustainable, keep prices lower, but also it means you have it in-house. You don't have to rely on it being imported. So I think this will actually accelerate the greening of the European economy, even though for the next couple of years that may be slightly counterintuitive.
Good. So next sector will be credit, risk sectors. So fixed income is year to date around 20%. Probably big part of it is because of rates, because are higher, but as well it's because of credit. Credit is wider. We've seen the spreads. I was checking yesterday. The Bloomberg Global High Yield Index yield is 10%. That's really a lot. So Will, your last comment, I read your monthly comments. You said credit price is compelling, but probably we haven't seen the peaks. So that was last month.
Yeah.
A lot has happened the last 25 days. So is it cheap? Is not yet cheap enough?
Yeah, I think in particular the sort of US high yield sort of opportunity spaces that we see are in those very, very high quality types of names, but that have had significant sort of price sell-off. So we've been carrying a very high cash balance, so we're able to enter at a very low dollar price, a high yield. So you're first of all getting that sort of yield compensation, but then it's that capital return and that sort of that possibility on capital return that we feel is so important. But again, we're certainly not saying this is not a wholesale move into whether that's sort of US high yield or some select. We actually, one of the sort of big opportunities we see is the euro-denominated names of US issuers who have been thrown out with the bathwater with the rest of European credit. So again, we see select opportunities there. This year, we favored sort of price givers to the market rather than price takers. But I think, again, what's important, the Inflation Reduction Act in the sort of US, that huge sort of stimulus into renewables. And fine, there's some very exciting renewable companies, but it's the utilities, the quite boring utilities that are now going to be the biggest developers, operators of renewables going forward. And the US is very happy to sell Europe as much LNG as they can find on ships and replacing that with their own sort of domestic supply. But I think important one more thing to bring it back to the macro, that traditionally when the sort of dollar was, or sort of when commodities had been sort of this high, the dollar would be falling off a cliff. But the fact you've now got the US as a net energy exporter has really changed things. And we feel that that might prolong this sort of cycle further. The dollar is overvalued on almost every single metric one can look at, but we think it can overshoot and continue to overshoot going forward.
Okay. So David, in Europe, same question. You came to Madrid in early July, and in all the meetings we had with investors, you said many times that credit is cheap, but it can be cheaper. So after 2 months, it's cheaper than in July, but same question, is it cheap enough? Not yet?
I think that in Europe, I mean, if you look at European spreads versus US spreads, they're actually better. If you look at European high yield, I would say it's probably better than US high yield because European high yield is a very high quality index. It's, almost 2/3 is double B. And so it is very high quality. So we like both high yield and investment grade. It's just what pace do you buy it at? I mean, that's really the question. It's not whether or not you want to own it. It is also pricing in recession. I mean, if you look at where credit gets to in Europe during recession, it's already above that. So it is pricing in a mild recession. And I do think there's just this general global view. I just don't want to own anything in Europe because it's a mess, and you have that war on the border, and I just don't want to deal with that. So we think now is the time to start buying credit, but buying it slowly. And our short duration products, we think that that's probably one of the best places to buy credit. 1 to 3 year is incredibly attractive. You can now buy 3-year paper for single A names that is at 3.5%, 3 3/4. And I think if you look forward in that kind of couple years, you'll say that's actually a really good thing to purchase. But also we're looking at high quality high yield, double B plus, double B. We think there's a lot of areas there where we can add significant value. But also within the government structure too. Look at all the different governments within Europe. There's a lot of dislocation going on there. Look at Estonia. It's just an example. It's 10 years, 200 over Germany. It's widened a lot this year. Why? Because it's physically located next to Russia. Completely understand that. But its debt to GDP is 8%. I mean, it's the lowest debt to GDP in Europe. And so it's really what you should be looking at as the fundamentals. Or if you think Russia's just going to roll tanks across the border in every country in Europe, then don't really worry about fixed income or equities, because that's not really what we should be focused on. But I think that, from that perspective, you want to start buying credit now. But I don't think you want to buy everything. I think you want to start buying. That's what we've started to do in our total return fund and our short duration funds. Slowly buying, build it up over the next couple of quarters. But I do think when you look back in 2 years, you'll go, in the fourth quarter of 2022, I really wish I'd bought more European credit. And why didn't I?
Okay. And talking about Europe, we always ask you about Spain and Italy. So, no, why?
In Italy, they always ask me about Italy. This is weird. Okay.
So short duration bonds in Italy, 2 years bonds are yielding 3% versus 2% German or 2.3 Spain. Do you see value there? Do you think with the new government that they will try to do things that could widen this spread?
Yeah, I don't see value in Italy yet. In all of our accounts, we don't own any Italian governments, and we're short. I think that there could be volatility over the next couple months, as I alluded to earlier, that I think will present an opportunity to be able to buy Italy. But also that may knock into other countries, such as Spain. Spain we like, it's fine. It's actually better quality than France. It's better quality than Italy. It should trade probably next to France, if not through France. But also I think there's a lot of other dislocations that are you don't have to go into the periphery. Look at Austria. Austria is a AAA rated govie that now trades wide of France, and historically has always traded about 30 to 40 inside of France. So you don't have to go into credit, but there's lots of country arguments to make as well. And so I think you really want to look for, you're getting really big dislocations in the market. That's usually the sign that you're getting close to a turning point, and so you want to start looking at how do I invest and buy those.
Okay. So a lot of questions about rates, bonds. What about equities, Derek? So the US Standard & Poor's is minus 22% year to date. Earnings for the next quarter, let's see what is going to happen. So how do you see? I mean, most of our investors, they have bonds, they have equities, and they are thinking about, well, do we have to see another sell-off from where we are? It's time to buy. So how do you see that? And of course, from a sustainability point of view.
Yeah. So no doubt that markets across asset classes are very challenging right now. And so, U.S. equities is similar. We're, as you said, down over 20% year to date. Multiples have compressed, and they're more reasonable, but they're not exactly cheap yet. So, we have to be mindful of that. Whether we go into a recession or not, it's looking increasingly likely, and so there could be more downside in that scenario. And so we could see multiples compress a little further. And then, of course, we have earnings that are likely to be revised lower as the economy weakens. I think the more cyclical areas of the market are obviously more vulnerable to that than sort of higher quality and growth-oriented companies. So that's tends to be where we focus in our strategy. Sustainability leaders are, in our view, companies that have very strong financial characteristics, so strong balance sheets, high returns on capital. They generate free cash flow, and that free cash flow is deployed in a shareholder-friendly way. And then from a sustainability perspective, these are companies that are solving global challenges. And so demand for their products and services should be strong. If we look, historically, companies with our highest ESG ratings, which is what my fund would focus on, have outperformed. High-quality companies tend to do better, as well as high-quality growth companies in more challenging economic environments. Those are the companies that we emphasize in our strategy. So I wish I had a crystal ball and knew how much downside was remaining. It's difficult to know, but we've also seen historically that once markets have corrected 20%, if you look at bear markets going back to the 1940s, typically that's not a bad entry point. And if you look out 12 months from now, on average you see double-digit positive returns after a 20% correction. So it's very hard to time the market, but I think, as Warren Buffett said, it's better to be greedy when people are fearful. And I think we're, close to the type of environment where people should be, getting into the market as opposed to getting out.
Okay, thank you. So we still have 10 minutes to go. So I would like you to ask as a final wrap-up. So in, let's say, 3 minutes, you manage many strategies, but the strategies that we are focusing on, so will Brandywine Global Income Optimizer, it's a truly global and truly flexible fund, and we've been through challenging periods in the past with great and amazing performance, one of the best funds in long-term performance. So how would you convince our audience to really look at the fund, and how are you positioned as a general view?
Yeah, so I think, as sort of Nico said, it's a truly global fund that has no structural biases. Our favorite number is 0. If we don't like a sector, we don't need to own it. And I think that, again, is part of that sort of generalist nature of our investment team. And again, that by combining that top-down macroeconomic work with that bottom-up fundamental work, we're able to take advantage of both valuation anomalies and sort of cross-sector anomalies that potentially sort of other investment teams won't. And having that 36-year track record of global bonds, there weren't many people doing global bonds 35 years ago, having that experience in duration and able to use duration as an additional asset class to protect both on the downside but also on the upside really makes us stand out from the crowd. And we like to sort of say, like, how would you sum up the strategy in one sentence? And it's this high yield levels of return with that global ag levels of volatility. And sort of those two sort of combinations combined gives very, very attractive risk-adjusted returns throughout the cycle. But I think it's that ability to take a step back when we don't see opportunities to carry a higher cash balance than maybe we would like, to be able to take advantage March 2020, to be able to go out to the market, reverse inquiring, being able to take down those sort of recessionary level spreads when you suddenly have that sort of the market stepping in and you've got those central bankers stepping in. So it's that ability to pivot, that ability to be highly opportunistic, but not take sort of undue risk when you're not getting paid to take that risk, which I think sort of becomes apparent in the sort of outcomes that we've delivered over the last 13 years in this strategy, but over the last sort of for the last 36 years at Brandywine.
Thank you. Derek. So, I started, and for those who doesn't know ClearBridge is a leader in ESG US equities. And your fund, as Article 8, is one of the strategies that we are marketing the most here in Spain among our equities strategies. So, same thing. You have 3 minutes. Why ClearBridge? Why US sustainability leaders?
Sure. So ClearBridge manages about $160 billion in primarily US equities. We've been integrating ES research into our investment process for a very long time. We started managing socially responsible portfolios back in the 1980s. The fund that I manage is relatively new. It's about 7 years old. But it's really our highest expression of high sustainability companies within a portfolio that we offer at ClearBridge. So the companies that we emphasize, and I've mentioned this already, but just to repeat, high quality with leading sustainability profiles. There's a lot of academic evidence looking over multiple market cycles that companies that have those attributes have tended to outperform the markets. My fund is relatively new, but over the 7 years that we've been managing the portfolio, we have been successful in protecting capital in more challenging markets. So I have about an 85% down capture ratio, and we've basically participated fully in up markets at about 100%. So the environment, we think, for companies focused on sustainability themes, particularly climate change, renewable energy, is as bright as it's ever been with the passage of the Inflation Reduction Act, and I talked about all the benefits of that bill. So we think that transition that we think is firmly in place to renewable energy, certainly in the United States, is going to accelerate as a result of that legislation. So I think the timing from that perspective is good. And the US economy is generally pretty resilient. I'm not saying we're not going to face a recession, but I don't think it's going to be too onerous or severe. And we've always come out stronger on the other end of these cycles. So no one's going to get the timing perfect, but I think if you're patient, you have that long-term investment horizon, I think you'll be happy that you're invested in a product like this.
Thank you, Derek. So, David. David is our head in Franklin Templeton Fixed Income Group. He manages a wide range of funds. In the past, we talked a lot about the European Total Return, which is the flagship fund. But recently, let's say the last 2 years, we've been pushing one of his ideas, the Franklin Euro Short Duration Fund. The reason is, well, rates were going to go up. Investors were looking for defensive strategies. Euro short funds are like core in our portfolios, and the Franklin Euro Short Duration it's like the first or second fund in in 1 year, year to date, 3 years, 5 years. So, same question, David. Why Euro Short Duration, Franklin?
Well, I think that probably the main reason to think about Euro short duration is markets are volatile at the moment. It is difficult to actually commit capital to them. But I think you do need to start doing that. I know many people are running very high cash balances. And a lot of people are asking, well, shouldn't we be jumping back in? And I think that really the easiest way to do that is start off with something that's relatively boring, for lack of a better word. It's a very simple product. It invests just in European assets, so you don't have anything outside of Europe to worry about. It actually is an Article 8 fund. It's very dark green, in my opinion, has a feeble fin label. We really focus on sustainability of the assets in it. And also, I think that, fixed income can actually have a bigger impact on changing the discussion on social as well as environmental than our equity colleagues, because we can and we are engaging with sovereigns, which is something that no other asset class can do, or they choose not to. And so we can actually change policy or help influence policy. And so I think that is actually a good reason to look at a fund and a complex that does do that. And it's part of our greater suite too. So we have 7 Article 8 funds and 3 Article 9 funds, all in European fixed income, that is really focused on how do we drive this forward. But I think if you want to start by, look at a short duration fund, it will get you access to short duration credit, which we think is the sweet spot at the moment to actually look at on a risk return basis in Europe. It's something that is a big building block within Europe. And we are very short duration at the moment. We're about 0.8 years versus an index of 2. But we are actively looking at when do we start to lengthen, so that you don't have to make that decision of, should we be in cash or should we be in 3 years duration or 8 years duration. We will move that duration out for you, take advantage of that, and its long-term track record shows that we can do that.
So, thank you, David. So, I think we are done with this. Muchas gracias a todos por estar hoy aquí. Como resumen, bueno, teníamos 1 hora y media, no queríamos alargarlo más. En el pasado estos eventos duraban 4 o 5 horas y cada gestor hablaba 40 minutos, pero los tiempos cambian, vuestros tiempos son más preciados y no nos podemos retener tanto. Entonces, espero que haya sido interesante. Creo que hemos oído 3 ideas, 3 tendencias en la primera parte que son de primera línea: innovación, infraestructuras, cambio climático. Y esta segunda parte, aunque en 45 minutos no da para tocar muchos temas, yo espero que hayamos podido por lo menos sacar ideas que os interesen, que por supuesto luego a cualquiera de nosotros nos podéis preguntar, os podemos montar una call como quieran los gestores para poder profundizar. Y con 3 gestores muy distintos. Will, de Brandywine, una idea flexible, realmente flexible y realmente global, y eso si miráis el fondo vais a ver cómo hemos tenido años como 2020, 2021, donde lo hemos hecho increíble por ser capaces de quitarnos de duración cuando el mercado caía. 2022 a lo mejor no tan bien, pero vamos a ver cómo acabamos el año. Esa flexibilidad que tiene Brandy One. Derek, Clearbridge. Clearbridge es una gestora de referencia en ESG. Cada vez demandáis más fondos artículos 8 y en renta variable Estados Unidos tampoco hay tanto. De verdad que es una estrategia a considerar. Y David, bueno, David le tenemos aquí en Europa, viene muy a menudo, es la estrategia Franklin Short Duration que más hablamos ahora, porque es el momento probablemente de tener algo defensivo. Todos vuestros clientes, todos los fondos de fondos tienen inversiones en renta fija europea a corto plazo y si encima tienes uno de los mejores fondos de la categoría, mejor. Y con esto me quedan 5 segundos, 3, 2, 1 y terminamos. Muchas gracias a todos y ahora nos tomamos un café si queréis, ¿vale?